It's Sunday night. Your laptop is open. Your inbox is already filling up. You're not technically working yet, but mentally, you never stopped. There's a message from your manager marked Monday Priorities. There's a Slack notification from a coworker asking if you can quickly jump on a call tomorrow. And there's that familiar feeling in your chest. Not panic. Not even stress exactly. Just a low-grade awareness that your entire life depends on showing up again at 9 a.m. You can't afford a bad month. You can't afford a risky decision. You can't afford to say no. Because your income exists only as long as you do. And this is where most people misunderstand wealth. They think wealth is about having millions. But real financial power begins much earlier, at the moment when money starts arriving whether you work that day or not. There is a specific mechanism that creates this shift. Not overnight, not magically, but predictably. And today we're going to talk about how 3 simple dividend stocks can become the foundation of long-term passive wealth. Not fantasy wealth. Real, slow, durable financial independence. Most people chase growth. They look for explosive returns, trending stocks, next-generation technologies. And there's nothing wrong with growth investing. But growth creates uncertainty. Dividend income creates predictability. Predictability changes behavior. When you know that a certain amount of cash will land in your account every quarter, your decisions begin to shift. You stop thinking purely in terms of survival. You begin thinking in terms of strategy. This is the hidden transition most investors never consciously notice. Passive income isn't just financial. It's psychological. Across developed economies, the majority of working professionals rely on one primary income stream, a salary. And according to multiple household finance surveys, fewer than 25% of adults receive meaningful passive income from investments. Among those who do, the median annual dividend income is surprisingly modest, often less than a few $1,000s per year, which means most people are building their financial lives on a single pillar. If that pillar shakes, layoffs, illness, industry changes, the entire structure becomes unstable. Dividend investing offers a second pillar, one that grows quietly over time. Consider Daniel and Ryan. Both are 36 years old. Both earn approximately $85,000 per year. Both started investing around the same time. Daniel focuses entirely on saving cash and contributing to retirement funds without a clear dividend strategy. Ryan spent the last 7 years building a dividend portfolio. Today Ryan receives roughly $900 per month in dividend income. Daniel receives none. On the surface their lifestyles look similar. Same apartments. Similar vacations. Similar careers. But their internal experiences are dramatically different. Daniel feels pressure to maintain income growth every year. Ryan feels pressure too, but also has a growing sense that time is slowly shifting back into his control. Behavioral research consistently shows that financial uncertainty consumes cognitive bandwidth. When your expenses rely entirely on future effort, your brain remains in a state of background vigilance. This affects decision-making, risk tolerance, career negotiations, even creativity. Predictable income, even at relatively modest levels, reduces this psychological load. It creates mental space. And mental space is often the hidden ingredient behind better long-term financial decisions. Career choices begin to change. Ryan feels more comfortable pursuing lateral opportunities or negotiating compensation. Daniel delays those conversations. Health decisions shift too. Financial pressure influences sleep, diet, and long-term stress levels. Emergency expenses become less disruptive. When unexpected costs arise, dividend income doesn't eliminate the problem, but it reduces its emotional intensity. Relationships also change. Money conflicts often stem from uncertainty. Predictable income reduces that uncertainty. And perhaps most importantly, investing behavior evolves. Investors with dividend income streams are statistically less likely to panic during market volatility, because part of their return arrives as cash regardless of market sentiment. Now let's talk about how this actually happens. Dividend wealth is rarely built through a single stock or sudden windfall. It's built through consistent accumulation and reinvestment. Today we'll focus on 3 dividend stocks often used as core long-term holdings. Not because they are exciting, but because they are durable. Stock 1, Procter Gamble. This company has paid dividends for over a century. Its business model is built around essential consumer products. Demand for toothpaste, detergent, and household goods remains relatively stable even during economic downturns. This stability supports reliable dividend growth. An investor contributing consistently over a decade may see modest yield expansion combined with capital appreciation. Stock 2 Johnson & Johnson. Healthcare demand tends to persist regardless of economic cycles. A diversified pharmaceutical and medical products business creates resilience. Dividend increases over multiple decades demonstrate a long-term shareholder return strategy. While no stock is risk-free, companies with durable competitive advantages often sustain predictable payouts. Often called the monthly dividend company, this real estate investment trust focuses on commercial properties leased to established businesses. Rental income becomes shareholder income. Monthly dividend payments provide a psychological benefit. Investors experience passive income more frequently. This frequency reinforces long-term investing discipline. The compounding effect. Imagine an investor allocating $800 per month across diversified dividend holdings. Assuming moderate yield and reinvestment, passive income may initially feel insignificant. Perhaps $20, then $60, then $150 per month. But over time, dividend growth and additional contributions accelerate progress. After 10 to 15 years, the income stream can begin covering major life expenses. At that stage, financial decisions start to transform. Not because wealth suddenly appeared, but because consistency quietly reshaped the future. Future vision, the slow shift toward autonomy. Ryan's portfolio reaches $2,000 per month in dividend income by his mid-40s. He doesn't retire. He doesn't dramatically change his lifestyle. But something subtle happens. Career risks feel manageable. Entrepreneurial experiments become possible. Market downturns feel less threatening. Compounding continues uninterrupted. This is the real power of dividend investing. Not dramatic wealth, but gradual autonomy. Philosophical closing, the meaning of passive wealth. Financial independence is often imagined as a finish line, a moment when work stops and life begins. But in reality, independence usually arrives in stages. The first stage is simply knowing that part of your life is funded by past decisions. Dividend stocks represent one path toward that reality. They reward patience, consistency, long-term thinking. And eventually they offer something far more valuable than income. They offer options. Because wealth is not defined by how much you spend. It is defined by how freely you can decide. And passive income, even in modest amounts, is often the first quiet step toward that freedom.